Hello and welcome to The Inside Basis, Unleashing the Power of Tax, a podcast from global law firm K&L Gates. Each episode looks through the lens of corporate tax law to examine current issues impacting business. We hope you enjoy the discussion. Please reach out to suggest topics or guests or with questions about corporate tax law.
Welcome to the Inside Basis tax podcast brought to you by K&L Gates. I'm Randy Clark. I'm an M&A tax partner at K&L, and I'm also your host. Today, we're going to talk about a very common topic in middle market M&A transactions, the F-Reorganization. This type of reorganization is a commonly used tool to achieve what can otherwise feel like disparate objectives in a transaction between a buyer and a closely held target. It enables combining a step up in tax basis to a buyer to the extent of any cash consideration, and facilitates tax deferral for rollover equity on that portion of the consideration. While we'll talk about some considerations on rollover equity in the future, on this episode, we're going to focus on how this type of transaction is commonly used with an S-corporation target. F-reorganizations involving S-corporations are subject to some specific guidance and, in my view, are the more prevalent use of this transaction in the market. A typical approach to accomplish an F-reorganization is described in a specific revenue ruling, in IRS Revenue Ruling 2008-18. In that ruling, an existing S-corporation is contributed to a new corporation, and following such contribution, a qualified subchapter S subsidiary, or what's called a Q-sub election, is made for the former S-corporation. That's one of the situations in the revenue ruling. There is a second situation, but we're not going to cover that here. When that Q-sub election is made in connection with an F-reorganization, as described in that ruling, the S-election for the historical S-corporation automatically carries over to the new holding company. So no new S-election is required for the holding company. And separately, what is considered an important facet of the 2008 ruling is that the historical S-corporation is also treated as retaining its EIN, or employer identification number. Importantly, under some older historical EIN guidance, an F-reorganization using a similar approach or similar form, but involving a C corporation, is generally considered to cause the C corporation to lose its EIN to the newly formed parent. Revenue Ruling 2008-18 helped clarify that in a multi-party F-reorganization involving an S corporation, that historical company, the S corporation, is able to retain its EIN when it becomes a Q-sub. This can be helpful operationally going forward because there's fewer changes to payroll matters at the operating company itself. And it can also be helpful in some non-tax contexts where the EIN is an identifier used for an important customer or important payment source. Following a typical F-reorganization transaction like I've described, it's also common to have the historical corporation now as a Q-sub under the new holding company convert to an LLC under state law. This is done because status as a Q-sub is actually a special type of pass-through tax status that is only available to entities that are one, corporations for tax purposes, and two, wholly owned by an S corporation. An LLC, however, can be passed through for income tax purposes for any owner, whether that be an S corporation or any other entity or person. Importantly, then, when that converted LLC is sold, all or part of it, that's also governed by another revenue ruling, 99-5. And in that ruling, the sale of interest in a single member LLC by a single member to another owner is treated by law as a transfer of a prorated interest in all of the underlying assets of the LLC, followed by a contribution to a new partnership for tax purposes. Importantly, it's also possible to roll over interest in that LLC. And as a result, this is how the desired objectives of each party in an M&A transaction involving one of these companies, objectives of a buyer being a step up in tax basis to the extent of cash consideration, and the objectives of the seller seeking tax deferral on the rollover portion of consideration, can both be achieved. In a typical F-reorganization, the rollover equity is commonly delivered to the new holding company itself, which is treated for tax purposes as if it was a continuation of the historical S corporation that was reorganized. Now, we're not going to talk about this today, but to the extent that the continuing S corporation has multiple owners, and those owners don't want to own the rollover equity in the same proportion that they historically owned the S corporation, and then, of course, will own the new holding company, some tax deferral can be lost. So our goal of this podcast was to talk about a couple common issues that come up in F-Reorganizations that can either jeopardize the reorganization itself or limit the favorable results intended to the parties. The first one is the built-in gains tax imposed by Section 1374 of the Internal Revenue Code. So because income of S corporations is subject generally only to a single layer of federal income tax, and because C corporations pay a separate layer of corporate income tax, it can be considered desirable for some shareholders of C corporations, if they are eligible, to cause the C corporation to make an S election and become an S corporation. To prevent abuses of this approach, to prevent C corporations from making an S election and then immediately engaging in asset sales subject to a single layer of tax, and to prevent certain other transactions that could similarly mitigate the imposition of corporate tax on C corporations and former C corporations, what Section 1374 of the Code does is it generally imposes C corporation tax, an entity-level income tax, on built-in gains that were in place at the time an S election is made for a C corporation. Those gains are subject to tax to the extent they're realized within a 5-year period from the date of the S election. Now, critically, this 5-year period is more like an on and off switch. It is not a slowly burning off or slowly amortizing tax that would be paid. So whether you engage in an asset sale transaction 4 years or 1 year after an S election for a C corporation, 1374 applies. However, if the recognition event is more than 4 years after the S election date, there's generally going to be no built-in gains tax, subject to some other diligence considerations that would generally be more entity and transaction specific. The key point to take away is that merely engaging in an F reorganization may not be enough to achieve a buyer and seller's tax goals, to the extent that 1374 and this built-in gains tax needs to be considered. The most common issue that we address in F reorganizations is timing, and it's a critical reason to have your tax attorneys, your CPA, or your counsel involved early when you're considering this type of reorganization. And the most important timing point to consider is that in an F reorganization, the Q sub-election that's to be made for the contributed target is subject to a pretty unique timing rule. So, like entity classification elections, there's some retroactivity permitted for Q sub-elections, but the corporation that is the subject of a Q sub-election must be a corporation on 2 days: the date that the election is identified as effective in the filing itself, and the day that the election is actually filed. Now, because it's very common in M&A transactions to follow an F reorganization with an LLC conversion, the timing of the Q-sub filing and its effective date and the subsequent LLC conversion is important, because a conversion prior to the date on which the Q-sub election is effective and filed could jeopardize the ability of that historical S corporation to make a valid Q-sub election. This timing issue and an early LLC conversion appears to be the subject of a private letter ruling. It's 2017-24013, if you'd like to read it. And importantly, when a Q sub-election cannot be properly made, the favorable EIN carryover rules in Revenue Ruling 2008-18 may also be jeopardized. So as a result, it's very important to carefully consider the timing of both effective dates and filing dates of your Q sub-election, and however you're coordinating that with any state law entity changes or conversions in any F reorganization. An additional common issue that we see in F reorganizations relates to the entity that will be used as the new holding company. From a federal income tax perspective, an entity that is legally organized as a corporation under state law is treated as a corporation for tax purposes. However, an entity that is organized under state law but not incorporated, such as a limited liability company or a limited partnership, is generally able to elect its federal income tax classification. Now, as a result, an entity formed as an LLC under state law could elect to be treated as a corporation for income tax purposes, or it could accept its default classification. An LLC formed under state law would, by default in the U.S., be treated as a disregarded entity if it's owned by a single member, or as a partnership if it's owned by multiple members. Importantly, the holding company that was set up in Revenue Ruling 2008-18 was identified in the ruling as a corporation for tax purposes. And again, because that ruling supports EIN retention by the existing S corporation and the carryover of the S election to the new holding company, it is critical to track the facts of that ruling where possible. So either using a new corporate holdco or ensuring that the LLC is treated as a corporation for tax purposes. An interesting quirk here is that if you were to organize an entity as an LLC and make an outright S election for it, not in connection with an F-Reorganization, that S election actually results in a deemed corporate entity classification election being made for the LLC. And then only after that deemed corporate election is made for the LLC, it becomes a corporation for tax purposes, does the S election itself become effective for the resulting corporate entity. Critical piece of this to remember is that assuming this deemed election approach applies in an F-Reorganization and skipping a step could make the F-Reorganization ineffective, and it could have other very negative consequences that we won't get into more detail on. If an LLC is formed to be the holding company, then that default tax status is something that to be taken account. And if it controls the contribution of the historical S corporation to that new holding company can result in the S election of the historical company actually terminating and no Q-sub election being permissible. The fix to this is fairly straightforward. If a corporate election is made for the LLC prior to the contribution occurring in connection with an F-Reorganization, the LLC will be treated as a corporation for tax purposes, and the use of an LLC can therefore still be consistent with the corporate holding company formed in Revenue Ruling 2008-18. So it's very important to consider the type of entity used as the new holding company, what that means from a tax perspective, anytime you're considering an F-Reorganization. And finally, we have one note on the retention of the historical S corporation's EIN in connection with an F-Reorganization. It's generally accepted that a state law conversion of a historical corporation to an LLC following an F-Reorganization likely results in the converted LLC retaining the EIN of its predecessor corporation. In some instances, tax practitioners will also take additional steps in order to either notify the IRS of the intention to preserve and continue to use that EIN, or to seek specific confirmation that that EIN has been carried over. However, some older EIN guidance raised a concern about EIN retention where an LLC conversion is attempted in states that don't permit what's called a formless or statutory conversion. In those types of conversions, formless or statutory, an entity basically converts directly under state law from a corporation to an LLC. The paperwork is filed, used to be a corporation, is now an LLC. An alternative way to accomplish what is the same result as an LLC conversion in a state that doesn't permit a formless or statutory conversion is to approach it via a merger. In these states, the corporation that's intending to convert to an LLC merges with and into a new LLC, with the new LLC surviving. While those approaches used to raise additional risk as to EIN retention, updates in the Internal Revenue Manual that the IRS uses that were made in January of 2022 appear to suggest that the IRS is now willing to be more flexible about the ability to retain a historical EIN where conversion uses that merger mechanic in states that don't permit formless or statutory conversions. This guidance is taxpayer favorable because among practitioners, it was fairly difficult to discern why EIN retention should be limited to states that made formless or statutory LLC conversions possible. Now, of course, while these are common issues that we see, these are not necessarily the only issues that may come up when engaging in an F-Reorganization. However, because these transactions are so common in the market and these issues are so commonly missed, we hope that this episode will help smooth the execution of these types of reorganizations going forward, both for interested buyers and for interested sellers. Again, I am Randy Clark with The Inside Basis, a tax podcast brought to you by K&L Gates, and we appreciate you listening.
Thank you for listening to this episode of The Inside Basis, Unleashing the Power of Tax. To listen to past episodes and receive notices for new episodes, subscribe by searching Hub Talks. That's HUB Talks in your favorite podcast app. Tune in next time for more corporate tax insights.